Ever wondered how credit default swaps are priced? Well, it's not as complex as it sounds. Let's take a journey together through the world of financial derivatives and delve deeper into the pricing mechanism of these fascinating instruments. Now, imagine you're a lender. You've lent a large sum of money to a company, perhaps a fledgling startup with promising prospects. You had faith in their vision, their ability to make a significant impact, and therefore, you invested. But over time, you start to get nervous about their ability to pay you back. The market conditions are shifting, there's uncertainty in the air, and the once promising startup is starting to reveal cracks in its facade. So, what do? You decide to buy a form of insurance known as a credit default swap, or CDS. A credit default swap is a financial contract, a kind of derivative used as a hedge against the risk of default. The buyer of the CDS, in this case you, makes regular payments to the seller. And in exchange, you receive a payoff if the company to whom you've lent money defaults on their loan. It's like buying insurance on your neighbor's house. You pay a premium to sit back and watch, knowing you'll be compensated if things go south. It's a way of mitigating your risk, of cushioning the blow should the worst-case scenario unfold. Now this brings us to our main question. How do you determine the cost of this insurance? Or in other words, how are credit default swaps priced? The pricing of a credit default swap is a complex process that depends on several factors. First and foremost, there's the credit risk of the reference entity. That's the company you've lent money to. If they have a high credit risk, meaning they're more likely to default on their loan, the cost of the CDS will be higher. Think about it. If your neighbor's house is made of wood and prone to termite infestation, you'd expect to pay a higher premium than if it was made of concrete, right? It's the same with credit default swaps. The higher the perceived risk of the reference entity, the higher the cost of swap. Secondly, market conditions play a significant role. If the general economic environment is unstable, or if there's a high level of uncertainty, the cost of the CDS will increase. It's akin to the cost of insurance going up after a major natural disaster. During times of financial turmoil, economic crises, or even political instability, the cost of credit default swaps can surge. Then, we have the creditworthiness of the reference entity. This is determined by credit rating agencies who meticulously assess the likelihood of the entity defaulting on its debt. The parameters for assessment include the company's financial health, its earnings prospects, the industry it operates in, and the overall business environment. The lower the credit rating, the higher the cost of the CDS. Finally, the term or maturity of the credit default swap also affects its pricing. The longer the term of the CDS, the higher its cost, as the risk of default increases over time. This is intuitive. The longer the time frame, the higher the chances of unforeseen circumstances leading a default. To illustrate, let's go back in time to the financial crisis in 2008. During this tumultuous period, the cost of credit default swaps for risky companies skyrocketed. As the market conditions worsened and the creditworthiness of many companies declined, the cost of insuring against their default shot up. So, to sum up, the pricing of credit default swaps depends on a mixture of factors: the credit risk of the reference entity, market conditions, the creditworthiness of the reference entity, and the maturity of the swap. It's a delicate balance of these factors that enables lenders to manage their risk effectively and protect their investments. Credit default swaps are an integral part of the global financial system. They provide a means for lenders to manage risk, and their pricing is a reflection of the complex interplay of various risk factors. The world of credit default swaps is indeed a fascinating realm of risk, reward, and financial acrobatics. And there you have it. An expanded look into the world of credit default swaps and how they are priced. It's a captivating world of risk, reward, and financial acrobatics, don't you think?